looking at the data we've seen coming through of late, especially out of the US, but also out of the likes of Germany, India, China, reflecting that we could see some economic uptick into next year. But many doubtful about actual follow through here, because too much of what we are seeing is coming off a very low base anyway. What's your perspective on the kind of economic tales being told?
Absolutely, Alishia. I think if you really look at it, a bit of a mixed bag in terms of data coming out. Especially recently, we've seen a lot of positive data coming out of the US. Yesterday, really the data coming out, a little bit of lackluster data, with participants really expecting a bit more out of the US economy. Also, the fact that a lot of the recovery has been pivotal or really linked to the quantitative easing, which is still pervasive throughout the market. So I think, as long as that cloud hangs over the market, investors are going to be wary, really looking out for when that does withdraw. And I think the policy response both across the US and Europe will really dictate where markets go into 2011.
Because there are pockets of optimism to be scouting out for. I mean, with the global economy not in sync, a trader has got to be pretty selective in terms of where he or she's going to be putting his money next, right?
Absolutely. I think, with regards to the quantitative easing, I mean, the US has really printed lots of money. It's in the system. It's, flushing through the system. We've seen commodity prices being fairly strong. We've seen developing economies really benefiting. So a bit of a mixed picture globally. I think if you actually have a look at the global picture, you've got very strong growth out of Asia. You've got very strong growth in India, for example. So, investors really needing to be quite selective in terms of where that money is going to flow and where the growth is going to come from going forward. I think your developed economies certainly facing significant headwinds, and they're going to have to look for that growth elsewhere.
Let's take a look at your analysis of what we're seeing play out in Europe right now. More downgrades coming to the fore, and the situation seeming to be getting worse before it gets any better.
Absolutely. I think Europe, again, quite a mixed bag. Very different economies in Europe. There's been a lot of talk out of Germany, favoring austerity measures rather than a rampant quantitative easing or effectively printing money into the system. This really impacting, and there are certain geopolitical considerations that go with that. I mean, you're seeing Greece recently passing their revised budget for 2011, being faced with rampant public riots. So the question is there a will or an ability for Europe to actually, review their budget decisions, and Europe really looking quite sick at this point in time. The potential for downgrades, still looming quite large, and that's going to raise the cost of issuing debt in the new year and going forward.
Well, within this context, let's take a look at the South African market here, because we've been saying all along that earnings need to start justifying a PE level on the market, sitting at around about 17 times PE. But a report out of Macquarie earlier this year just highlighting that if you take the Aussie, the historic PE ratio sits at 16.8. Yes, that higher than the average of 12%, and it certainly makes the market look expensive. But if you take out roughly, I think it was about 8 shares out of that index, it brings the market down to a PE of 14.4. So the market not necessarily expensive here, Mohammed.
Alishia, our market is really interesting in that respect, in that it's a fairly small market when compared to global norms. And in that regard, a lot of our counters, specifically in your top 40, are skewed towards the resource sector. Your resource stocks generally tend to trade at very elevated multiples. And I think if you strip out a lot of your resource stocks, you will definitely see that there are pockets of value, especially if you're looking at a PE multiple as your basis. There are certainly pockets of value. If you look over the last year, you will have seen that in specific, your industrial sector has really performed and shot the lights out. And in that sector, you will have seen your retailers really having phenomenal years. You've seen certain stocks rising, either on the back of corporate action or just pure price movement to the extent of, around 40 to 50% on the year. So, absolutely, investors need to be cautious. Have a look, especially if you're looking for value. There are certainly pockets of value even in our local market.
Where are you looking out for that value at this stage? And let's get stock specific right now, Mohammed.
Alishia, I think it really does depend on the policy response into 2011. A lot of investors really now looking for a strategy into at least the first half of next year. And again, if the policy response globally is going to be one of further quantitative easing, I think commodities and equities across the board will likely benefit from that. If, however, the policy response tends towards proper fiscal austerity measures, arguably equities and commodities could be in for a bit of headwind. So almost a bipolar approach approach over there. But again, really the intent looking as though the world quite keen on averting a crisis, on averting recession, and really quite willing to put that quantitative easing into the market. If that persists and continues, I think the South African market and in specific equities, given that our equity market is skewed towards commodities, are likely to be large beneficiaries of that.
Let's take a look at a few of the players here, because where corporations have been more prudent than governments in most respects in terms of management of their affairs, we've got this expectation of a flurry of new deals next year, share buybacks and dividend hikes as well heading into 2011, and expectation when it comes to that centered on BHP Billiton. We know that the company's already announced a $4.2 billion share buyback, but much more of that being put on the cards at this stage.
Absolutely. I think, investors are now really in a position to place pressures on corporates. If you look across the board, many corporates are sitting with very, very healthy balance sheets. They're sitting with a lot of cash on the balance sheet. And investors are really going to be applying the pressure to make sure that corporations either utilize that capital in terms of furthering growth or acquisitions. And if they're not going to actually deliver that growth to shareholders, the investors are really going to demand that some of that cash be returned into shareholders' hands. So again, if you look across the board, you've mentioned BHP Billiton. We've seen some interest, especially in the corporate action with regards to Billiton, having a look at potash in Canada. And there are a couple of other stories out there, for example, Rio Tinto in Australia looking at Riversdale. This really stemming from investor pressure on these corporations to actively deploy those cash balances to start generating further shareholder value.
Let's look at that Rio Tinto deal. It's looking at pursuing coal mine at Riversdale at a price tag of $3.9 billion. What have you made of that move?
Again, you're starting to see a lot of consolidation, especially on the upper end of your commodity players in that space. So again, we've mentioned BHP Billiton, and now this Rio deal with Riversdale, really quite strategic. They're targeting the coking coal operations, obviously that Riversdale play in that space, and Riversdale having operations in South Africa and then concentrated, especially in Mozambique. This really looking to bulk up and complement Rio's portfolio on a global scale, and is really showing that if the demand from China, from the East, and from your developing economies really does materialize, that players like Rio and BHP Billiton are really looking at ramping up their capacity to be able to satisfy that demand.
Let's take a look at how Anglo American compares here. It's completed that 577 million Australian dollar for sale of undeveloped coal assets in Australia, and some seeing this as a bid to consolidate its assets and pursue growth more aggressively moving forward.
Yes, I mean, Anglo American over the last, let's call it 2 to 3 years, has been an interesting story. There's been quite a bit of pressure from investors in terms of realigning the portfolio, making sure that what you see with Anglos is either we get a diversified play and Anglo starts to play in a similar space to BHP Billiton's, or arguably gets relegated in terms of the kind of space it plays in. The fact that they're willing to dispose of non-core assets, really quite positive. I think, shows an intent by management to really focus on the core activities, focus on the activities that Anglos arguably are best at, with a view of delivering some of that value through to the shareholders and to investors over the longer term. Anglos and Billiton's both having had a fantastic year over the last year, with their share pricing really ratcheting up. The question here really becomes, in terms of management style, who really triumphs as a relative play.
Very quickly, I was reading that, if there are sectors that stand out, yes, you've got the industrials on the one hand, you've got resources as well, but within the industrial space, building and construction and information technology counters really standing out. Interestingly enough, we've had MTN and Vodacom seeing nice runs this week. Vodacom today, though, coming under quite a bit of pressure.
Absolutely. I think Vodacom, on the back of some news out that they may potentially be looking at selling their unit in the Congo. They have appointed Rothschild as their advisor in terms of reviewing their Congo operations, and that's really on the back of a fairly poor performance in some of their African operations. They had a fairly poor performance out of Nigeria. So, a bit of a question mark in terms of their strategy across the rest of the continent. And then also some news out of Vodacom that Shamil Jusuf, who was the managing director of Vodacom South Africa, has recently tendered his resignation and will be joining Vodafone Group as the CEO of their Spanish operations. This, again, arguably being taken quite negatively by the market. Vodacom coming under a bit of pressure today.